As you would all know, that PL Asset Management has taken a very differentiated approach to investing. And we created over the last 4 years a complete advanced quant infrastructure, which is where and by which all our investment strategies are powered. As you also know, on the forefront of this innovation of quant-based investing is Siddharth Vora, who is PL's fund manager and head of quant investment strategies. Siddharth is a CA, CFA, MSc in business excellence and a CMT level 2 cleared person, appearing for a CMT level 3 in near future, but leads his team of experts in the field of data science, computer programming, economics and statistics, finance, risk. So very different skill set. The whole idea of our quant-based investing and walking that path was to design models which can remove human biases, the basics of greed and fear, and help us navigate markets generating consistent alpha. Of course, while the first year performance of our PMS more than justifies our effort, as it has created more than 20% plus alpha, which means the good market is also beaten by substantially better performance than the benchmark. But now is the time, and which is what we used to always hear from all the clients, that we will watch you, how you navigate the bad times. And to that effort, I would say that we are more than satisfied, as because of the array of meters that we have created and almost 9,000 plus data points which talk to each other before giving outlook on markets, sectors, styles and stocks. We were early enough to shift our clients' portfolios. And that has helped save a lot of this downside which has happened in some sectors, some stocks, and of course, overall markets. I'll take a pause for a minute to show what Siddharth had been telling on markets for last 4+ months. And after that, I'll ask Siddharth to take us through what all our quant meters are suggesting about markets and market outlook, and how should we really navigate these periods so that we come out with less bruises, be ready to participate in the long-term bull run of India. So most of us are convinced about our 10-year cycle, but what do we do for our next 3, 6 and 12-month cycle? Let's keep hearing from Siddharth after a short video for all of you.
Valuation, breadth, sentiment and volatility indicators, most of them are at cyclical peaks and troughs, which again suggest a case of mean reversion.
That we believe that the strategy must now change from return maximization to risk minimization.
We've gone from a value momentum style orientation to a quality and low volatility style orientation for the past 4 months.
So for the last 1 year, we were mainly dominated by cyclicals. We've now finally started adding non-cyclicals as well to the portfolio.
We have completely taken a very, very defensive stance to sectors such as consumer staples, healthcare, consumer discretionary, and IT.
Markets, likely to consolidate with a bearish bias. Good evening, everyone. And thank you so much, for taking out your time and joining us for this session today, where we're going to talk not just about what we make of the markets from a very quantitative basis, but also what we've really done in our portfolio, how we've really navigated the last 4 to 5 months, which have been quite a challenging period for the markets. So I thank all the investors, partners, and participants across Zoom, YouTube, and all other channels to take out their time and join us today. So I think let's first straight go into what the market is looking like today and everything that we're hearing about the market. So I'm just going to quickly pull out a slide which tells us everything that is going right and going wrong. And these are all the stories we're hearing. There is a weak beginning to the corporate results season. There is talks about US rate cuts. We've already seen 50 basis points, and we're likely to see one more cut in the near future. We're seeing China making a strong comeback for the FIIs. We're seeing everyone talking about how scary India valuations are, and everyone finds India expensive. On one hand, we're seeing bond yields rise in the near term. On the other hand, we are seeing US elections causing volatility and a risk-off sentiment for a lot of large FIIs. After a period of 3 years, we've seen momentum in the Indian markets break off. There's also a lot of wars going on around the world, which keeps crude very volatile. We've seen record FII outflows. I think this range of outflows is higher than even the COVID cycle. Across the board, we are seeing the market breadth is reducing. There's a weakness in the overall market breadth, and we might see a comeback of more polarized and narrow markets. Gold has become a preferred asset class because of its appeal in a rate cut cycle, because of its appeal during geopolitical stresses, because of the global de-dollarization that's happening. And of course, central bank buying gold across the world keeps it in a very steady demand cycle. We're also seeing the festive season, beginning in India, and we're coming out of a very good and strong monsoon. So these are some of the positives. But if I look at the near-term commentary, then we are seeing auto sales are slowing down. After 3 long years, or rather 4 long years, quality as a style is now being looked at once again. The financialization of savings is a mega trend in India, which is increasing the monthly SIP book to record highs every single month, which is keeping the DII flows very, very strong. In a way, this is shielding any major correction in the Indian markets. And so far, what have we really seen? It's a 7 to 8% corrections across large cap, mid cap, and small cap. If the same intensity of FII selling was happening without the DIIs being able to absorb it, we would have usually seen a 20% sort of correction. But we've managed to arrest the correction at a 7-8% sort of level. On the one hand, we are also hearing that mid and small caps are very expensive and large caps are fairly valued, which is true. But large caps are more vulnerable to FII selling, and mid and small caps are very well shielded from a DII flows perspective. So the broader point I'm trying to make is there are a lot of things happening in India. There are a lot of good and bad things happening around the world. And given that Indian markets are richly valued, we should likely see a phase of consolidation with a bearish bias rather than a runaway rally from here on. That is the broad view. And now I'm going to display some key analysis and charts that we've produced to be able to substantiate this view. So firstly, I'm not going to spend too much time on this because everyone knows that India is the fastest growing major economy in the world. Whether I talk about GDP growth rate, the size of the GDP, or now even the size of our stock market. We are now among the top 5 players, whether it's GDP or market cap. Secondly, we've got some very positive long-term structural tailwinds, whether we look at the working age population or our debt to GDP ratio as well, compared to our closest peer, which is China. And given everybody is talking about India and China, it's very important to understand that in India, valuations are expensive on a PE basis or a PB basis. And China valuations are cheap on a PE and PB basis. But if you look at PEG, on a PEG basis, India is still the most superior market. Over the last 10 years, China has probably grown its economy at a 1%, grown its earnings at a 1% CAGR. India has grown its earnings at a 12% CAGR. I'm talking about Nifty 50. So on a PEG basis, India is still the better placed market. Yes, there is a short-term sentiment and a shift away from away from India into China because of the valuation differential. And the broad FII mindset could be all the good news is sort of in the price in India and all the bad news is in the price in China. And therefore, they were underweight China and overweight India, probably trying to rationalize that allocation as well. But I don't think this has long legs, given that structurally, India is still the better economy and still the better market. And China has deep structural issues. And if you look at the sort of economic stimulus packages that were announced, once the details were out, I don't think FIIs were too gung-ho about Chinese markets as well. The other thing to sort of understand is from a monetary cycle perspective, whether I look at credit spreads or duration spreads, they are low and on the reducing trajectory over a structural basis. So from a monetary cycle perspective, equities are still Indian equities are well placed. So when I'm looking at the monetary cycle as well, reducing spreads is usually very, very good for equities. And I think that now that we are coming out of a 4-year rate hike cycle, on a structural basis, equities, more specifically emerging market equities, are very well placed. Now, I think it's very important to also look at what are the key factors and parameters that have really changed in the market. So firstly, let's just look at the broad asset class view. When I look at, say, equity versus gold, what is becoming more and more evident is that globally, equities are seeing a mean reversion in returns as opposed to gold, and gold is the asset class that is actually outperforming equities. This is, of course, a lot to do with the rate cuts and the geopolitical stress that we are seeing around the world. Even when I look at this in terms of 10-year GSEC, we are likely to see a sort of mean reversion in the near term, which means the asset class view here is that we need to be a little cautious, a little defensive, and shift our focus from return maximization to risk minimization. I think what we saw over the last, say, 16 months, till June 2024, there was a clear trend. Stay in risk on assets, focus on equities, try to capture alpha by capturing higher returns on the upside. Since June 2024, the focus has shifted in the markets, where now we need to defend the alpha, we need to protect capital, and need to safeguard returns in a turbulent and more of a consolidative market. And that is exactly how our meters and strategies are designed. And I will take you guys through how the portfolio has changed in the last 4 to 5 months. Even when I look at the equal weighted market index versus the market cap weighted index, it is suggesting that the equal weighted index is underperforming. What this means is that the breadth of the market is reducing and there is likely to be higher amounts of polarization in the market. The markets are going to get narrower. So the sort of broad-based rally that we saw over the last 3 years, that could end and we could move into a more stock specific, sector specific, bottoms up approach, where again, value conscious, quality conscious, liquidity conscious strategies would help investors navigate this turbulent period. And I think the biggest change, and the change that is least spoken about, is the change in market style. Over the last 2 years, we've seen that momentum as a strategy has been working in India. Over the last few months, momentum has started outperforming the lower risk approach to investing. Over the last few months, value as a style, which was dominant between 2022 to 2024, has now started underperforming quality. So after a very long time, quality as a style is making a comeback into the Indian markets. And this is simply because value as a basket of stocks or as a style of investing has become very expensive. And quality as a basket of stocks or a style of investing has become under-owned and cheap. And therefore, investors must pay special attention to how their portfolio is allocated to high momentum stocks versus low volatility stocks, and how their portfolio is allocated to the so-called value stocks versus the broadly classified quality stocks. I think the bigger way or the better way to deal with this turbulence is to use a quality and low volatility tilt in your portfolio. So over the last 4 months, we were very early in turning our portfolio strategy to a quality low vol portfolio from a value momentum portfolio. Even when I look at the sectoral picture, what is very evident is that cyclical sectors are now starting to underperform their non-cyclical counterparts. So it's probably time to have a layer of defense in your portfolio by focusing on sectors such as healthcare, consumer, IT, select banks, defensive financials like AMCs and insurance. It's probably time to include a set of defensive sectors in your portfolio as opposed to the pro-cyclical high beta sectors. Now I will show you guys some key names as well. And as we've seen over the last 2 years, the broader breadth of the market has been reducing. So over the last 2 years, we saw 62% of all stocks outperforming markets. But as we narrow down the cycle, we are seeing a lesser percentage of stocks actually beating the markets. We are now down to roughly 44. This is a classical situation that reducing breadth is leading to narrower markets, and narrower markets also lead to a consolidation in overall market returns. So the big takeaway here is that one should have a more modest expectation of return in the near term, given all the factors that are at play. And a big question here that comes to mind of many investors is it time to go to cash? So if I look at my cash model and I just give you a little snapshot of what the cash model is saying, more indicators are now turning bearish as opposed to say 2 months back. But we still don't go to cash till a majority of the indicators have turned bearish. So right now we are facing a 50-50 split. 50% of our indicators do suggest that we must go to cash, and 50% of our indicators are still saying that the cycle is strong and there could be minor volatility, but still we need to avoid going into a cash call. Other than cash call, there are many methods to defend your portfolio in a downturn. One of them being reducing your portfolio beta, one of them being going into defensive sectors, the other being changing your market cap allocation, and the final one being changing your investment style. So what we've done in the aqua portfolio is that we've balanced the market cap mix in a way that it's equally split in a barbell sort of approach, where 33% of the portfolio is large cap, 37 is mid cap, and 30 is small cap. And the reason for this is, as I mentioned earlier, that large caps are extremely vulnerable to FII selling. And if you see the last 1 month data, large caps have also fallen roughly 7%. Mid and small caps have also fallen in the 7-8% range. So it is not that because it's a defensive or risk off cycle, large caps will do much better and they won't fall. All the asset class groups or the size groups are underperforming with equal level of intensity. What we've done in terms of our sectoral mix is defensive sectors like healthcare, consumer, defensive financials, materials, IT, and select auto names. These are dominating our current portfolio construct. We have completely moved out of capital goods, industrials, defense, railway, real estate, infrastructure, PSU banks. These are some of the sectors which we used to hold till June in our portfolio, but we've not held them since June. And in terms of the style tilt, our model is following a 50-50 style tilt between quality and low volatility. Even if you see how the average market cap of the portfolio has evolved, what becomes evident is that yes, till December, it was a easy money phase in the market where the bull market was strong, momentum was dominant, and smaller caps used to help generate alpha. Post December, we saw a transition in the cycle where larger caps became the focus area for the portfolio. And now, given the diverse effects of FIIs and DIIs, we've taken a more balanced approach to market cap. But if you look at the broader trend compared to the easy money phase of December, our market cap, average market cap is still almost 2x. So we have gone into large caps and larger mid caps. Even if I look at the live portfolio beta, I think what is very interesting to see is how with agility, our models have reduced the portfolio beta from 1.5 levels to roughly 0.75 levels over the last 4 months in a stepwise, in a step manner. So again, what our models are indicating is that we need to stay in the markets, but reduce the beta, which is the sensitivity of the portfolio in relation to the markets. And if I look at how we've rotated sectors over the last few months, again, as I said, industrials were very dominant in our portfolio till June. But since June, we've had a zero weight to industrials. Auto was a big overweight till June. We've gradually been reducing auto in our portfolio. Financials were an underweight. We've gradually been increasing our weight to financials. Healthcare, we did not own till April, but since June, we've been gradually owning a significant overweight on healthcare. Like this, consumer discretionary has now become an important sector. IT is gradually rising in our portfolio, and all the higher beta sectors have sort of become zero in our portfolio. So the interesting part of the aqua portfolio strategy is that it does not need to take a benchmark linked sector weight. It can take a completely contrarian call to the benchmark. We could go highly overweight, underweight, or even have zero weight to a certain set of stocks or sectors. And this is what helps us generate alpha. If we look at the correction of all the different sector indices from their recent 52-week high, what is very evident is that healthcare, IT, pharma, these are sectors which have shown more resilience. These are some of the overweight sectors for us. Sectors like defense, media, PSU banks, oil and gas, real estate, these have seen some very sharp corrections. And fortunately, the aqua portfolio has zero exposure to these sectors. Even in the previous rebalance, I think healthcare has been a very defensive bet. Consumer has been a defensive bet, and they have done very well. And when I say they've done very well, I say it more from a perspective of protecting alpha, curtailing drawdowns, and minimizing risk rather than generating absolute upside. Now, it is very important to also understand what sort of return expectations investors can have in cycles like this. So what we've done here is populated the returns of aqua strategy, Nifty 500, Nifty small cap, Nifty 50, Nifty micro cap in a 3-month, 6-month, and 12-month forward basis when our model suggests that we are in a quality or low volatility regime. As of now, we are in a low volatility regime. And based on all the historic data, we see that usually equities underperform in a low vol regime with almost flattish returns. say Nifty 500 is roughly in the 1% mark. Small cap gives you like a 1% drawdown. Nifty 50 on average outperforms, which is a large cap bias with a 1.45% sort of return. Micro cap underperforms. So the whole idea here is how does aqua usually navigate these cycles? So based on all the backtested return that we've seen for the last 18 years, our data suggests that aqua usually generates 3% odd returns on a 3-month forward basis in a low vol cycle, 7% odd returns on a 6-month forward basis in a low vol cycle, and roughly 25-27% return on a 12-month forward basis. This is very different from the sort of returns investors are used to over the last 3 years. I think most investors have seen their portfolios grow multifold, and now is the time to sort of become more realistic and modest about what kind of returns should we expect, how to shift focus from returns alone to risk-adjusted returns. A quick highlight of some of the stocks that have done very well for us so far over the last 15 months. This is just a snapshot of some of our holdings. Most of these are not in our portfolio now, but again, this gives you an idea of what sort of returns are generated by the key holdings of aqua. Whether we talk about names like Cochin Shipyard, BSE, Aircon, NBCC, Mazgaon Dock, they've generated returns north of 100%. And whether we look at names like Bajaj Auto, Indigo, M&M, Blue Star, some of the more private sector names, these have also generated healthy returns. But the broader idea of this slide is to show you how style agnostic aqua is. We are neither averse to PSUs nor pro PSUs. We are neither averse to sectors like infrastructure, real estate, capital goods, nor averse to sectors like private banks, IT, consumer. This strategy is designed to adapt and change its construct based on the market cycle that we operate. In a certain cycle, we could use more aggressive sectors and styles in our portfolio. In a certain other cycle, we could use defensive sectors and styles in our portfolio, like we're doing now. And to sum all of this up, in a simple number, we break up the market into 2 phases, the bull market and the consolidation. The bull market is what we believe lasted till 30th June 2024. The 1-year return for the strategy as of 30th June 2024 was in the 76.2% range, which was 2x benchmark. If I look at the portfolio returns since 30th June till 15th October, which is the middle of this month, we have still managed to generate alpha and hold on to alpha and returns even during extremely choppy and volatile markets. As I showed you all, to what extent markets and sector breadth has reduced over the last 3 months. Despite that, our portfolio was well positioned to protect capital and generate alpha for investors. How the risk metrics for the fund look like. Our returns since inception are close to 61.34% as of 30th September. Our alpha since inception is close to 21.92%. The volatility of the fund has been in the 20.91% range, which is in line with markets. So the Nifty 500 volatility or BSE 500 volatility is also roughly 21%. So with volatility of the fund being in line with the markets, we've generated alpha close to 21%, which makes our Sharpe ratio at 2.18 and Sortino at 2.12. Sharpe and Sortino ratios are simple measures that tell you how much excess return are we generating for every unit of risk that we are taking. A ratio above 1 suggests that the strategy is generating more returns as opposed to the risk it is taking. So far, the highest drawdown we've had in the portfolio is roughly 10.5%. And the highest monthly drawdown that we've had in aqua has been roughly 1.78%. So since we've gone live, I think on a monthly basis, we've not seen drawdowns higher than 1.7%. With that, I would actually like to take a quick segment of some questions before we move into the next segment of a quantitative lens to show you the market outlook. So, is this a good time for a new investor to invest in aqua? So I think Yogesh has sent that question again. So yeah, I think we've seen a 7-8% sort of correction in the markets, and common sense and prudence suggests that investors who use market corrections to enter will usually have a slightly higher margin of safety in terms of entry points and overall long-term compounding. Having said that, aqua as a strategy is designed so that investors don't have to time the market or time a particular style of investing or time a particular sector. Aqua does all the timing for you. So had you probably invested in aqua 6-7 months back, we would have been more of a momentum and value fund. But as of today, we will be more of a quality and low vol fund. The fund itself changes its colors and investing style based on the market cycle. So I think no one doesn't need to worry about timing the markets or entry into the fund. One second. The next question is from Ramesh. Is the bull run over and downtrend has set in the market? So again, very clear answer here. As I said, we are in a phase of consolidation. We are in a phase of change in investment style. We are in a phase of change in sectoral preferences from cyclicals to non-cyclicals. We're in a phase where markets are going to become more polarized and narrow. We are in a phase where risk minimization is more important. And all of this is probably something that could last a couple of months. It's a short-term phase where we could see markets consolidate with a bearish bias. But the structural long-term bull run of India is very much intact. I think till this froth around valuation in mid and small caps is not removed with some correction, and till FIIs don't turn constructive on India, the large caps will not start outperforming. So overall, couple of months where we could be sideways and more volatile, eventually to make way for the next big rally in the markets.
If I may add here,
Yes.
a simple anecdote that, in the capital goods segment, we have Siemens and ABB, who are not only MNC companies, who have certain products and technology which gives them an edge in terms of giving services to clients. They have tremendous management capability to hire the best talent. If they are at, say, 70 and 80 Ps, even the SME IPOs, micro caps, small caps, market left the distinction and started valuing even those stocks in these sectors at 50, 60, 70 Ps, which is where a huge anomaly or bubble has happened, if you ask me. And when we continuously say, apart from the aqua PMS, which generally focuses on top 300 stocks, if you are not in aqua PMS and you have your own exposure in the markets, what does it mean to shift to quality? What does it mean to shift to liquidity? What does it mean to shift to low volatility is very important. Where is the froth? The big froth is in those segments where the management capability cannot sustain that kind of continuous growth and so cannot command these valuations. So markets will bounce back, but some stocks will not bounce back. Some stocks you will not get that valuation again. So that's why it's very important to rebalance your portfolio quickly, without fear, and protect the gain which overall you all have made, and come to what does it mean quality and low vol, where the managements are proven, where the cash flows are strong, where the return ratios of the businesses are very good. So look at your portfolios and do that in case you don't want to invest in aqua. But if you invest in aqua, as what Siddharth explained, the navigation of the different market cycles will be much easier for you. Over to you
And-
again, Siddharth.
Yes, and I think for all those participants, who don't know what the investment process is followed by the aqua strategy, I'll take a couple of minutes to, quickly take you all through. So it's a very simple three-step process. It starts with a layer of quantitative top-down analysis, where we do three things. We try to ascertain what is the risk environment from a macro and market perspective. Should we take more risk? Should we take less risk? How much risk to take in the current market cycle? Our models understand multiple different, monetary, macro, sentiment, valuation indicators to determine which risk regime are we in, and therefore determine what should be our asset allocation between equity and cash, what should be the market cap mix, which sector should we focus on, what is the beta of the portfolio that we should have. So the first segment is understanding risk. The second part of the top-down analysis layer is choosing which investment style to use. So again, our models evaluate multiple different investment styles in the market, like value, quality, growth, momentum, low volatility, dividend. And based on that, we decide in the given setup or in the current setup, which style would help generate alpha for investors. And therefore, this becomes a very critical decision. The third thing we try to do in the top-down layer is we evaluate all the different sectors and themes in India based on growth, valuation, momentum, volatility, sentiment, and then decide which are the sectors we should be currently focusing on. All the sectors are ranked from, say, rank 1 to rank 100 based on all these parameters. Once we've got a clarity, how much risk to take, which style to use, and which sectors to focus on, we then go on to the second layer, which is the bottom-up portfolio construction. I think, again, over here, we start with eliminating weak stocks. Our investment or evaluation universe is top 500 stocks by market cap. Out of this, we eliminate 100 stocks by fundamental red flags and another 100 stocks by liquidity filters. We're left with 300 stocks. Once we are down to these 300, we need to now choose top stocks to construct our portfolio. In order to do that, we again use a quantitative factor-based model where we evaluate multiple different factors and assign a factor rating or a factor score to each and every security. We use factors like sector, risk, fundamentals, technicals, valuations, investment style. All of these factors come together and every stock gets a final rank or a score. We choose the top 25 to 30 stocks based on which regime we are in. If we are in a low risk regime, we will diversify and create a 30 stock portfolio. If we are in a momentum or a growth regime, we will run a 25 stock portfolio. Finally, once the top ranking stocks are identified, we equally allocate to all of these stocks. So we run an equal weighted portfolio, which is benchmark agnostic. And finally, it is very important to understand that an equal weighted portfolio gives you well diversified risk and granular returns. Having a strategy or a portfolio that concentrates its holding in top 4-5 stocks, the entire return and risk of that portfolio is dependent on the top 4-5 stocks. As opposed to that, having a portfolio with an equal split across stocks gives you a well-scattered stream of returns and a well-scattered source of risk. This makes the strategy repeatable. So, say over the last 15 months, the fund has generated 87% absolute returns for investors. This 87% has come from an equal weighted portfolio, which makes it more repeatable. And finding one or two winners consistently becomes harder. But if your process is robust, in only that situation can you have a repeatable portfolio strategy. In step 3, what we focus on is responsive risk management. Over here, on a periodic basis, our portfolio is rebalanced. It is adjusted. It is adjusted in terms of which style, which sectors, and how much risk. These are the main 3 areas where the portfolio is adjusted for every 2 months. The other part of risk management is exiting stocks without biases. I think having an objective mathematical model to tell you which stocks to enter and which stocks to exit, make your investment journey a little more simple, a little more clear, because you're not emotionally attached or connected to a certain set of stocks or sectors. And finally, the most severe sort of risk management model that Aqua uses is the strategic cash call. Over the last 15 months, the model has not guided us to take any cash calls. But if it comes to that, the model is also equipped to go into cash up to 50%. And this whole 3-step process of top-down analysis, bottom-up construction, and risk management is repeated every 2 months. The fund was launched on 12th June 2023. The focus of the fund is to generate alpha for investors across market cycles. The benchmark is BSE 500 because it's a broad-based benchmark, and our strategy is also a flexi-cap PMS. And important clarification that yes, this is a pure quant strategy, but it's a long-only equity strategy. There is no, we don't use shorts, we don't use derivatives, we don't use options in this portfolio whatsoever. So it is a flexi cap strategy which is diversified across large, mid, and small cap. The maximum allocation we make to a particular stock at the time of entry is 4%. Again, this is an important principle of managing risk for investors and not getting too concentrated on a certain stock. Now, in the next 10 minutes, I will be sharing some of the proprietary quantitative indicators and models that we use on the back end. This will give you all even more insights into where we are in the current market cycle. I think let's start with market sentiment. This chart, percentage of stocks beating Nifty 500, what this indicates is that over the last 1 year, this number has actually peaked out. And with the original broader thesis that we had, that the markets are likely to become narrower, the markets are likely to become a little more polarized. I think data confirms that this has been the phenomenon that is happening. Even when I look at the average distance of stocks from their all-time high, it looks like we are sort of topping out for the near term. And mean reversion is a phenomena where we're basically saying that we saw a very strong uptrend, and now we are likely to revert back to the long-term average or the long-term mean. In a case like this, what happens is markets go into a phase where you see a temporary correction, a temporary switch in the investment regime in the market. And I think data confirms that we are in the cycle of transition. Another important sort of data to look at is if you look at small cap or mid cap, again, we are at cyclical highs, cyclical peaks, and we are reverting back to the mean. And usually this means that we should gravitate towards a more defensive approach to investing. But on the brighter side, what we can see is that we are still not in a bear market. This is a pause in the bull run, not the end of the bull run, because data again confirms that stocks which are trading near their all-time low are still close to zero. And we should not see a bear market till this indicator starts turning adverse. And even if I look at stocks near highs, again, we should be expecting a sort of mean reversion. We are again at a cyclical peak. All of this data suggests that short-term outlook is volatile, long-term outlook or structural outlook is good. So prepare to handle volatility. brace yourselves with defensive approaches, and moderate your return expectations. Even when I look at, the whole debate between large cap and small cap, again, it's becoming evident that finally, after a long time, large caps are now starting to gain a little favor as opposed to small caps when we start looking at them from a risk-adjusted basis. And if you look at the return spread between the two, we see that large caps will make a strong comeback over the next 1-2 years in India, simply because their valuations are reasonable, the earnings are stable, and they are broadly under-owned as a percentage of the total market cap as of today, as opposed to their smaller and mid-cap peers. Yes, this is the chart that sort of displays that. If you look at market cap percentage of top 50 stocks in the total market cap of top 500 stocks, we've been at a multi-decade low. The same is confirmed by BSE Sensex 30 market cap as a part of BSE 500. All of this again, confirms that large caps are under-owned, and the broad-based rally, which might end in the near future, will investors can actually take shield in larger caps to protect this. This again is another picture to show, everybody's talking about stretched valuations and euphoria in the smaller caps of the market. Again, data is sort of confirming that yes, there is sort of stretched valuation and euphoria in the small and mid cap pockets of the market. What is interesting to see though is mid caps as a category are less cyclical, and small caps as a category are extremely cyclical. So if you look at the current portfolio construct of Aqua for the last 4 months, large and mid caps control roughly 70 to 80% of the portfolio, and small caps are in the 20 to 30% range. So we have taken shield within the large and mid cap buckets as opposed to the smaller cap buckets. If you look at data between say 2006 to 2024, or even the recent COVID cycle, where small cap as a percentage of total market was roughly 6.5%. This number has now gone to 11%. In the exact same period, large cap, which was roughly 78% of the market, has gone down to 68%. Mid caps have steadily over a cycle increased their weightage. Even though in COVID they were roughly 16, they've increased by 4% to 20. So we've seen the biggest sort of correction in large caps as a percentage of total market cap, and this is likely to revert to the mean in the medium to long term. And again, the big point that I was making, that cyclical sectors and non-cyclical sectors, how should one be positioned here? Again, data confirms that cyclical sectors are likely to underperform and non-cyclical sectors are likely to outperform in a consolidative setup of the market. And finally, when you look at valuation, very evident that large caps still have some valuation comfort, and small caps, I'll just explain you what this means. So roughly 48% of large cap stocks are trading above their 3-year average PE. But in small cap, this is roughly 60%. And in mid caps, it's roughly 50%. So the idea is large and mid caps could be better positioned as opposed to small caps from a valuation perspective. And the same narrative is sort of confirmed by price to book charts as well. And overall, what our models are indicating is shift to low vol, shift to quality, reduce small caps, and focus on non-cyclical sectors. As an investor, these are some of the actionable insights that one can also consider in their portfolio. And I think with that, I sort of cover most of the topics that I wanted to address with all our investors and partners.
So Siddharth, that was a very good question. If we could just take it forward, where they wanted to know that how our models are shifting towards quality, and they wanted to understand more about that, which indicators led our models to move towards quality and a low vol.
Sure. So I think if we look at the portfolio construct till June and after June, there has been a big shift. So from June 23 to June 24, our models were running a value orientation in terms of fundamental style. In terms of technical orientation, we were running a momentum factor overweight. Since June, our style model, which basically evaluates roughly 12 different parameters for each style group, and then ranks which style is outperforming based on an outcome of these 12 parameters, decides that the style regime is shifting. We were actually amongst the first ones on the street to change our style allocation from momentum to low vol and from value to quality. And I think when we made this shift, of course, we were early. It didn't immediately start playing out. But if I look at the last 4 months, I think this style shift has really, really helped Aqua and all Aqua's investors to protect the downside in a meaningful way. Again, without divulging too much about which indicators are there, that will get too technical for this forum. We look at a combination of risk metrics, trend following indicators, mean reverting indicators, breadth indicators to arrive at which style basket should be the one that we should follow. Another last question. I think somebody's asked for our view on gold as well. I think they've said in the multi-asset funds that we are running, they wanted to get a insight on gold. So I think gold, we have been overweight on gold since 7-8 months. We've recently also increased allocation to gold. Over the last 8 months, we've had an average 15% allocation to gold. Now it's gone towards 20. And I think understanding gold is very critical in the current market setup, right? When interest rates are likely to reduce and have been cut, a non-yielding asset like gold would do well. When there's economic uncertainty, fear of recession, an asset like gold would do well. When there is geopolitical uncertainty and wars going around, asset like gold would do well. When central banks are buying, gold would do well. When there is de-dollarization, gold would do well. And now a new big trend that has happened in gold is ETF buying by retail investors. That is a new stream of demand altogether for precious metals. And when there is a sort of risk of sentiment also because of all these factors, gold does well. So I think gold needs 6-7 major triggers for it to do well. And this is a unique time in the history of markets where all of these 6-7 are batting for gold. So from a strategic point of view and a tactical point of view, gold is an important asset class to hold in the portfolio as of now. To end today's session, I would like to say that there is no need to worry. There is no need to be concerned, because there could be times when markets do very well and there could be times when markets don't do well. You need to stay centered and focused around the fact that we have a strategy that can change, that can adapt, and we have very strong quant processes and a very elaborate quant infrastructure to first understand that these cycles are changing and then react and change your portfolio to the changing market dynamics. What we believe truly is that we stick to the process, we follow the rules, we follow our quant models, and we let the rest be handled by markets. Our job is to build models and follow them, and the rest is not in our control. But if we are adaptive, we can sustain across market cycles. And the whole genesis of Aqua is to be adaptive across market cycles. And I think we've demonstrated this live over the last 15 months based on how we've changed our style, how agile we've been in terms of sector rotation, how we've made money in the bull market phase, how we've defended alpha in the consolidation phase. So I think processes and performance are both supporting the narrative that adaptability is the only key to long-term outperformance in the markets. So I thank you guys for joining us today and for investing with us in Aqua. So I thank all my partners, investors, and participants. And you can reach out to us on pms@plindia.com. Nupur bhai, just please put the email ID on the chat, so whoever wants to reach out to us for the next set of questions can easily get in touch with our teams.